Good morning and welcome to today's webcast, The Effects of Tax Reform on Utilities, Benefits, and Compensation. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And I'm pleased to introduce today's presenters, Wendy Campos, Partner, and Alex Nunley, Senior Manager. And Wendy, I'll turn the line over to you to get us started.
Thank you. I just want to highlight what our agenda will be for today. We're here to talk about tax reform. As you all know, there's a lot of changes that were made out there in a very quick time frame, signed into law on the 22nd of December. This presentation is specific to our utilities and power organizations. That could be public utilities, it could be cooperatives that are exempt under 501c12. So we're going to specifically hone in on provisions that will be applicable to you and then to some of your individual members, perhaps. We'll want to highlight compensation and fringe benefit changes, unrelated business income for those of you that applies to. Then we're just going to recap and highlight a few business provisions because there are some that tend to affect unrelated business income for those that applies to. And then just some other provisions just to make sure you're aware, high level, of what some other provisions are that are out there. And with that, I will turn it over to Alex to get us started.
Thank you, Wendy. As Wendy mentioned, I'm Alex Nunley, a tax senior manager here at Moss Adams in the Portland office. I'm going to talk about tax reform changes to compensation and fringe benefits, specifically how they impact one another and how they impact organizations such as yours. Under the new tax reform, there's a 21% excise tax on taxable compensation in excess of $1 million paid to covered employees. For purposes of this excise tax, taxable compensation includes base pay like salary, taxable fringe benefits, which I will talk about here shortly in greater detail, because there are some additional fringe benefits that are now includable as compensation under the new tax reform, whereas they were not includable before. In addition to fringe benefits, taxable compensation also includes severance pay and IRC 457F benefits in the year of vesting. A covered employee for this purpose is an employee that is one of 5 highest paid employees in the organization, or if they were a covered employee for any taxable year after 12/31/16. For example, if you have an employee that was a covered employee during 2017, but in 2018 they were not one of 5 highest paid employees, they're still considered a covered employee in 2018, and so their compensation in excess of $1 million would be subject to this excise tax.
And something to add there too. Sorry about that, Alex. I just wanted to add that once someone becomes a covered employee, they remain a covered employee going forward. So you still might identify 5 highest compensated employees that are covered employees, say, for 12/31/19, but if you had one the year before, they're going to remain a covered employee as well.
And so finally, with respect to the compensation and the excise tax, it applies to the following types of organizations. And so as you can see specifically, public utilities are included in this list. And also the payment and reporting of the excise tax is the responsibility of the organization, which means you'll want to give special attention to what the compensation package is and tracking those taxable fringe benefits so that you're always aware of what the compensation is and potentially what excise tax the organization could be subject to. And Emily, it looks like we have our first polling question.
All right. Our first question is, Jim, a covered employee, was paid total compensation of $2 million during the 2018 calendar year. What is the total excise tax on Jim's compensation? Your options are $42,000, $420,000, $210,000, or $21,000. And I'll give everyone a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. Give everyone a few more seconds here. And let's take a look at the results. Alex, back to you.
Thanks, Emily. So looking at this is coming out a little different than I would have expected. It looks like most of you were thinking it would be $420,000, which is 21% of the full $2 million. The excise tax is actually only imposed on the amount in excess of the $1 million threshold. So it would be $210,000 opposed to $420,000. Now moving on to fringe benefits. With respect to employee achievement awards, there wasn't any change in the actual law. Really all it did is kind of tighten up the definition of tangible personal property. So pre-reform law, it said that any employee achievement awards up to a certain threshold were excluded from wages of tangible personal property. However, now it says that tangible personal property specifically excludes items such as cash, gift cards, meals, lodging, stocks, and other similar types of items. Under pre-reform, people could kind of say, okay, well, I'm going to include cash and gift cards as tangible personal property and exclude those from the wages of the employee. Now, since the definition has been tightened up so much, and specifically excludes these sort of items, cash, gift cards. Any amount that's paid by cash, gift cards to an employee for an achievement award is definitely going to be includable in their wages. Next, moving expenses. Pre-reform law, reimbursements were excluded from the employee wages, and now they will be included in the employee's wages. This change is scheduled to sunset in 2025. But again, we don't really know. Anything could happen once we get closer to 2025. And also, please note that these moving expenses, it's only applicable to non-military personnel. So if it's military personnel, they're not subject to the reimbursements being included. Qualified transportation fringe benefits and qualified parking facility fringe benefits. Before, these were excluded from employee wages, and they continue to be excluded from employee wages. However, they are amounts that will be included and increase unrelated business income to the organization. And that brings us to our third polling question.
All right. During 2018, ABC Utilities paid $10,000 to move Dan, ABC's new CFO, to the city where ABC is located. Dan's base pay is $250,000 per year. What is Dan's total compensation for 2018? And your options are $240,000, $250,000, $260,000, or none of the above. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. I'll give everyone a few more moments to make a selection. And let's see what everyone has to say. Alex, back to you.
All right, looks like most everybody got this one correct. So yes, his total compensation for 2018 would be both his salary and the moving expenses. And so you can see that, if this would have been a year earlier, his compensation would have been $250,000, whereas now under new law, it's higher. And so you want to take into account the change in tax law to the taxable fringe benefits for determining compensation for purposes of determining the excise tax, and then also for payroll reporting, and again, the excise tax. So just to kind of wrap up and bring the two concepts together of compensation and fringe benefits, you'll want to really pay attention to the impact of what is now includable as compensation, and do the additional fringe benefits that are being offered to the employee, put that employee's compensation above the $1 million threshold, whereas if the taxable fringe benefits were a different amount, they wouldn't. And also, if it makes an employee now a covered employee, before, without any additional fringe benefits, maybe they were not one of the 5 highest compensated employees, but then when you add on those taxable fringe benefits, they now are. With that, making changes to accounting for fringe benefits and compensation, and also reviewing compensation packages to make sure that the compensation packages and how much you're paying employees align with the goals of the company's ability and wanting to pay that additional excise tax. And then also give thought to payroll tax considerations. This doesn't only impact how much the company will pay in excise tax potentially, but it also can impact payroll taxes, and then also it can impact UBI. And one more polling question.
Oh, and this is actually our third polling question. ABC Utilities has $150,000 UBI for the year ended December 31st, 2018. ABC also paid $10,000 of moving expenses for new employees and $5,000 for employee parking. What is ABC's 2018 UBIT? $135,000, $140,000, $165,000, or $150,000. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. Everyone, a few more seconds to make a selection. And let's see what everyone thinks. Alex, back to you.
All right, it looks like most everyone got this one correct as well. So yes, UBIT would be 165. You would start with your UBI and increase for moving expenses and for employee parking. And so again, 2018 results in higher, whereas before, if this was 2017, it would be lower. It would be the 150. So these changes in the fringe benefits do impact the UBIT in addition to the compensation of the employee. That's all I have on these two topics, so I will go ahead and turn it over to Wendy.
Great. Thank you, Alex. We have one slide here on credit for paid leave. This is part of the tax reform provisions. It's only available for 2 years, but there is now a credit that you would take as a general business credit. The unfortunate part is you can only take this against unrelated business income. So if you don't have any unrelated business income, this is not a credit that you're able to take against payroll taxes, for example, which is unfortunate. But it's a credit equal to 12.5% of the wages paid to qualified employees who are on family and medical leave. So, for example, maternity leave or paternity leave would qualify here. There are some eligibility criteria. There's got to be a written policy that allows full-time employees at least 2 weeks annual leave and then a prorated amount for part-time employees. Unfortunately, leave not paid for by state or local government, so government utilities, you wouldn't file for unrelated business income anyway, so there's 2 reasons this wouldn't apply to you. And then there's eligible employees' compensation is less than 60% threshold for highly compensated employees. So there is a provision in there to limit what highly compensated employees could get. But it's a nice feature. Again, if you do have unrelated business income, it's nice to have another credit out there that you're able to take advantage of, but just know that this is only available for 2018 and 2019. All right. Let's talk about some unrelated business income provisions, knowing that there's probably some of you that are part of this presentation that some of these slides are not going to apply to you. I think it's good information for you to know. And then we do have some slides at the end that are applicable to everyone, so hopefully you'll stick with us. The disallowed fringe benefit expenses reported as unrelated business income, Alex touched on those. I think I'll spend a little bit longer just taking a little bit deeper dive. And go back to one of the slides that we had previously. And then we'll talk about some unrelated business income activity bucketing, changes to net operating losses, changes in the corporate and trust tax rates, elimination of the alternative minimum tax, and then some other business changes. The elimination of the alternative minimum tax, we don't have a separate slide on that because it's pretty straightforward. That was eliminated for corporations. And because of that, most of our not-for-profit clients, our utility clients, are set up as corporations, so that therefore if you had unrelated business income in the past, you have to consider whether alternative minimum tax applies. That goes away. We don't usually see that very often, but it was something as a tax preparer we always had to consider, so at least just takes that off the table, which is nice. But let's go back to the fringe benefits for a few minutes. I want to touch a little more, if I can get to the right slide. All right, let's see. All right, Alex had gone over this slide on qualified transportation fringe and qualified parking facility. I want to take a deeper dive on these for a few minutes because we've had a lot of questions at our firm. There's also been a lot out there published by other CPA firms, by law firms. The employer's tax guide was recently updated to touch on these changes from tax reform. And it's really something the tax-exempt sector all code sections has really been, I would say, up in arms about, because it's a very foreign concept to have to include one of your costs for a benefit that you pay to an employee as unrelated business income. So qualified transportation, friends, this could be your bus passes you might provide to employees. It could be some sort of transit passes. If you are providing those to employees, so you as an employer are paying for those, like Alex said, those are still excluded from the employee's wages up to the applicable thresholds, but they're now unrelated business income. If you are a 501c12 cooperative, you're not a government entity, you're some other type of 501c organization, you would have to take that cost of the passes that you're paying for on behalf of your employees and report that on your 990T as unrelated business income and pay tax on that. Very foreign concept. They wrote this into the provision. Their intent was that it gets tax exempt in line with corporate taxpayers that can no longer deduct this expense. So that's really the reasoning behind it, but it's a very foreign concept for our tax exempt organization clients. The qualified parking, that one's a little trickier because you may own a building that has a parking lot. So you're not charging your employee to park in that lot when they come to work each day. And the way that the provision is written right now and the guidance that's come out in the employer's tax guide recently indicates that that is qualified parking. That's a qualified transportation fringe benefit because you're providing that employee a parking space in your parking lot. And there's a cost to doing that. There's maintenance of the lot, there might be lighting, you might have a security guard that you pay for. And so essentially, the way that everything is written right now and being interpreted, you would have to come up with what the cost is for all those parking spaces that are provided for employees, and that's the amount you would report on the 990T as unrelated business income. And again, as Alex said, that's the organization paying tax on the cost of that benefit that they're providing to their employees. Still not a taxable benefit to the employees, but the organization is going to pay tax on it, similar to a corporation not being able to deduct that for tax purposes. We've had questions about what if the employees, so going back to bus passes, for example, what if the employee is actually paying for the bus pass and we're letting them deduct it pre-tax from their paycheck? We're not providing the benefit as the employer. It doesn't seem like we should have to report that as unrelated business income. And unfortunately, this is an area that is still gray. We're still waiting for further guidance. The AICPA wrote a letter to Congress and the IRS about a month ago, and they had kind of their top priorities that they should be addressing. And in the tax exempt area, the qualified transportation fringe is one of those items. And this, in particular, if it's a pre-tax benefit that the employee is paying for, does an employer have to report that as unrelated business income? And I'm seeing different opinions out there from different law firms, different CPA firms. It's kind of all over the board. One would think intuitively, you as an employer don't have a cost to that, but the employer's tax guide that the IRS recently updated for this provision would suggest differently. So just keep that in mind, that's out there. More guidance is needed on that, and we are hoping to get that sooner rather than later. Right now, the IRS says June. I think that's pretty optimistic since we're already almost to mid-May. But know that that's out there if you're providing these benefits. And again, if you're a government public utility that's not subject to have to file a 990T or report unrelated business income, this isn't going to apply to you. The other one that's not on this slide is on-premise athletic facilities. That follows the same Reform Act provision. If you've got a building and you provide, there's a big room that's basically a workout facility for your employees, same thing. You've got to capture all of the costs to maintain that equipment, the cost of the equipment, and maybe that's depreciation on the equipment. Any water that you might supply in their towels, that type of thing. Any cost that you're putting into maintaining that facility that's on behalf of your employees, you would have to report that as unrelated business income as well. There is an exception. I think in the utilities area, that exception probably isn't going to apply, but the exception is that if the athletic facility is primarily used for customers, so in your case, members, we see this more in higher ed, where students primarily use the athletic facilities. That would be an exception. But again, I don't think that would apply here because you would probably have that for your employees and not let your members come in and use your athletic facility. All right. I just wanted to give a little more detail on that just because we've gotten a lot of questions in that area. All right, so going back to some other unrelated business income provisions, activity bucketing, this is another big change for the tax-exempt sector. For those of you that are 501c12s and you're subject to having to file for unrelated business income, you know, with our utilities, we often see maybe one activity, but oftentimes there might be two activities. Advertising is not that uncommon as an unrelated business income activity. Debt finance property, rental income is another one we see a lot in the utility area. Up till this point, through 12/31/17, if you have any unrelated business income, you compile all your activities together and you pay tax on the net taxable income figure, just one figure. You pay tax, or if you have a loss, you have a loss carry forward, and you track those carry forwards going forward. This new provision, as of 1/1/18, will now require you to track each of your activities separately. And I think from a behind-the-scenes, work paper, internal tracking perspective, I don't think this is that significant of a change. You're probably doing that already. I know our clients, where we prepare their returns, they usually give us schedules where it's all tracked separately. But the difference here that comes from this provision is that now, once it gets reported on a 2018 return going forward, each activity will be tracked separately. And they have not modified the 990T. We haven't seen any idea of what it might look like, but we are anticipating that it's going to have to change pretty significantly to incorporate this change. But the key, though, will be if you've got an advertising activity, for example, and that advertising activity generates net taxable income, but then you've got debt-financed rental income that generates a loss. In the past, you would just net those, so you could use the loss from one to offset the income from another, and you might have a net loss or you might have a smaller taxable income number. You now will pay tax on the taxable income activity one, and you will have a loss and carry that loss forward on activity two. So not only will net operating losses be tracked, but they'll also be tracked by activity going forward, because you will not be able to use a loss from one activity to offset the second activity. In terms of what is an activity, they have not defined that. That is another area that's been identified as needing guidance sooner rather than later. And again, they've said June. We are not optimistic that that's going to be the case. But really where we need more guidance is, again, the definition of an activity. If you wanted to kind of think about it from a just planning for it perspective, if you looked at the 990T, they've got a separate schedule for advertising. They have a separate schedule for rental income. They have a separate line for pass-through income. They've got a separate line for, gross receipts when there's cost of goods sold related to those. So you might be able to kind of think in those concepts just to have a bigger picture idea until further guidance is provided. But I would say definitely with our utilities, it's probably pretty straightforward. If you've got advertising, that's an activity. If you've got rental income, that's an activity. If you have interest in partnerships and you have multiple K1s, we're hoping the guidance says that's all one activity. However, if one of the partnership interests does rental activities, but another one has something to do with energy generation, those might turn out to be two separate activities. But that's where more guidance is really needed, is an example like that. And we'll talk about, there's a couple items on this slide that mention NOL carryovers, net operating loss carryforwards. We've got a couple slides on that, so I'm going to defer talking about those until we get to those slides. All right, this just gives you a visual of how this activity bucketing might work. I mentioned rental income, web advertising. We put a couple more in here. We put the disallowed fringe because that would be a gross receipt. We're not expecting you're going to see a lot of expenses to offset those fringe benefits. But this is what it might look like. And you can see on the tax line that you would pay tax on any income activities, even though you have other activities that have losses, and you would track those losses going forward. And then again, this reference on the bottom of the slide references the net operating loss, and I want to defer talking about those till we get to those slides. It makes it a little easier to follow. But it does give an example of what it would look like before December 31st in terms of the tax due, the net operating loss carry forward, and then for tax years beginning after December 31st, the tax due and the net operating loss carry forward. So you can just kind of see the differences there. And then one other thing I wanted to mention on the fringe benefits that I neglected to talk about, if you are a fiscal year end taxpayer, the fringe benefit change is as of 1/1/2018. So you could potentially have, if you were a June 30 year end, for example, or a March 31st, 2018 year end, you could potentially have 3 months or 6 months of disallowed fringe benefits that you're going to have to pick up on your 990T for that tax year. So just keep that in mind. Everything else on this slide, the bucketing, that would be for tax years beginning after December 31st, 2017. It's kind of confusing because when we're talking fringe benefits, you know, whenever you talk payroll, fringe benefits, taxable compensation, that tends to always be a calendar year conversation. UBI tends to follow your tax year, so just that's a little bit confusing, and we probably, I'll make a mental note for myself that we probably should highlight that on this slide even, just because the disallowed fringe, you might be picking up some of that for a 6-month or a 3-month period. All right, I alluded to net operating loss changes, and we're now here, so I want to talk about those a little bit. And keep in mind, this provision comes out of the corporate tax reform changes. And again, I mentioned this already, but that's because usually our utilities and a lot of not-for-profits in general are set up as not-for-profit corporations in the state. So for unrelated business income purposes, you follow all of the corporate tax law provisions. Changes to NOLs, the carry back and carry forward provisions have changed, and this impacts net operating losses, NOLs, generated in years ending after 12/31/17. New NOLs will only be able to offset 80% of taxable income going forward. So if you are a 12/31 year-end taxpayer and you generate, let's say you have a net operating loss carry forward already, we're going to have a slide here in a few minutes that's going to show a visual of under the old law, kind of a transition period, and then under the new law, just so you can kind of see how you apply the NOLs. Because what's going to happen is you're going to be able to utilize that entire NOL that you have right now that you generated before the tax reform changes took effect against all your activities and all your income until it's exhausted. But if you generate a new NOL in 12/31/18, for example, it's going to be under this new regime. It's only going to offset, if you have taxable income in 12/31/19, you'll only be able to offset 80% of that taxable income versus 100% that you used to be able to. You would essentially always count on 20% of your taxable income being taxed at least under this new regime once you've exhausted all your previous net operating losses. We do refer to the ASC 740 impact for audited financial statements. Your deferred tax assets for NOLs would need to be remeasured and then apply the new rate, which we haven't talked about yet, but we'll talk about the new rate. And then an impairment analysis would need to be revisited since new NOLs do not expire. The previous expiration was 20 years. there's now no longer an expiration on net operating losses. I mentioned that carryback provisions have changed as well. You used to be able to carry back a net operating loss for a corporation 2 years. You no longer have that opportunity going forward. All right, so here's a visual just to give you an idea of how you would apply these changes to net operating loss deductions. So the first on the left-hand side, this is for NOLs for fiscal years ending before January 1st, 2018. So the old rule, you could do a 2-year carryback, 20-year carry forward. It was allowed to offset 100% of taxable income in the year used and no bucketing of your unrelated business income activities. In the center, NOLs for fiscal years ending after 12/31/17, which is the transition rule, no carryback, an indefinite carryover, allowed to offset 100% of taxable income. So keep in mind, this is your NOLs ending after 12/31/17, and no bucketing. And then NOLs for tax years beginning after 12/31/17, everything is under the new rule. It's no carryback, indefinite carryover, limited to 80% of taxable income in the year used, and the bucketing is required. So you can see it gets confusing. There's going to be some administrative work to track if you have engaged a CPA like Moss Adams to prepare your return. I would envision we will be updating all of our carry forward schedules. They're not only going to track by year, they're going to track the old rule, the transition rule, and under the new rule. And they're also going to track by activity bucketing if you've got multiple unrelated business income activities. All right, I referred to tax rate changes a couple of times, but I want to hone in on that a little more. So the corporate rate, again, this is corporate tax, has been reduced from 35%, highest rate, keep that in mind, it was a graduated rate schedule, to a flat 21% for tax years beginning after 12/31/17. So for fiscal year filers, if that applies to you, you will use a blended tax rate for the year spanning 12/31/17. So for example, if you're a June 30th, 18 year-end taxpayer, you would apply a blended rate of essentially 28%. So 6 months at the 35% and 6 months of the 21% to your fiscal year 18 taxable income. And, you know, we use in our example 35% just for illustration purposes. But what I'm finding early on is that for our tax-exempt organizations, you tend to not have enough, your taxable income is usually not at the highest rate of the graduated tax rate brackets. You tend to be more at the 15% rate. So unfortunately, I don't know that this flat 21% is going to be a good change. It's probably going to cause more tax added in with the NOL changes and the activity bucketing, just because the bulk of our tax exempts that we do the work for have tended to be, by the time you get down to taxable income and you net all the activities together, have been in the lower rate. So just keep that in mind. I mean, it does make it simpler because it's just a flat rate now. We don't have to apply graduated rates. But I just wanted to mention that. And then we've got here on our last bullet point, the trust rate brackets were adjusted and reduced. We've got the 2017 and 2018. I really wasn't going to do any more than mention that. I don't think I've ever seen one of our utility clients set up as a trust. We see it more with our foundations and some of our pension plans, but we wanted to just make you aware of that. All right, we have another polling question, and I believe this might be our last or second to last polling question.
Yep, this is our final question. ABC Utilities generates a $500,000 net operating loss for the year ended December 31st, 2018. What are ABC's options for utilizing this NOL? And your options are carry back only, carry back or carry forward, ABC's choice, carry forward only, or nothing. NOLs are no longer allowed. I'll give everyone a few moments to think about this. And once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification widget, which is to the right of the slide view. Just a few more seconds to think about it. And let's take a look at the results. Wendy, back to you.
Great, thank you, Emily. Well, good. Just about everyone got that one right. That's correct. It would be carry forward only. And as CPAs, we try to stay away from the words only and always, but in this case, that is applicable. Carry forward only because the carry back has gone away for the tax years beginning after 12/31/17. So good job there. All right, we mentioned that we were going to highlight some other business provisions. And keep in mind, again, these would apply if you have applicable type activities or expenses that are unrelated business income only. If you are a utility or you're a government utility that doesn't have unrelated business income, these are really more for your information only. They're probably not going to apply for anything that you have to do with a tax filing, for example. Bonus depreciation and Section 179 deductions were expanded. There was expanded access to cash method accounting. Again, this is just a tax for tax methods, not your GAAP or book method. Limitations on deduction of business interest for businesses with average gross receipts of more than $25 million. DPAD, which is the domestic production deduction, that's been repealed for tax years beginning after 12/31/17. There are changes to research and development, that's R&D, expenses beginning in 2022. In terms of international, we don't see this very often with our power and utility clients, but just know that if you're investing in overseas, you're using blocker corporations, that's gotten much more complex in terms of footnotes, possible reduction in foreign tax credits. If you're conducting programs through foreign domiciled organizations, which we tend to see more with our higher education and foundation client base in the tax-exempt area, but there could be situations where the transition tax could apply. So just keep that in mind, again, more for your information. And then there's a new deduction for pass-through income, which is not applicable for corporate members or partners. So I wouldn't envision that applying for most, if not all of you that are probably online with us. All right, tax-exempt bonds. I don't see this very often, if at all, in our tax-exempt utility space, but wanted to mention it. Tax exemption for advance refunding bonds has been repealed for bonds issued after December 31st, 2017, and then the authority to issue tax credit bonds and direct pay bonds was also repealed. We've got some tax reform resources here. We have a whole page dedicated to tax reform. The AICPA does as well. NACUBO, this is related to higher ed. I believe that the utility organization, I haven't been to their website recently to see if they've got a page on tax reform. I would suspect that they may have at least something. Council on Foundations, and then the IRS. They've got a newsroom and some resources for tax law changes. And then we've also done a lot of alerts recently. We just recently did another one on the Fringe benefits. If you were to go to our tax reform page, you would be able to find that. We've done a lot on the different corporate changes and those other business provisions that we've highlighted. And then we did another one recently on charitable giving, which doesn't apply directly, I know, to a lot of you on the line, but if you've got related organizations, especially foundations, Corporations, obviously, we didn't mention that, but if you've got subsidiaries, which we see very often with our client base, all of these business provisions and some of these corporate tax provisions that we talked about applying to unrelated business income, those would also apply to those entities as well. I think with that, we can go ahead and pass it back and kick off any questions that anyone might have.
All right. Thank you, Wendy. We do have some time left for Q&A. If you have a question for our presenters, you can submit that now in the Q&A window under your slide view. And let's see what we have. If we allow employees to park in our parking lot at no charge and we are not charged anything for the parking spot, do we have an issue of reporting unrelated business income on qualified parking benefits?
This is Wendy. I can go ahead and take this question. Very good question. There was some recent dialogue. I was at a conference last week and I spoke on this same topic. And we had a lot of questions about the qualified transportation fringe benefits. And one of my colleagues had been at a conference the week before. And there were some speakers that were not Moss Adams and some professionals had applied some IRS guidance that says that if you don't charge anybody for parking and you're just allowing an employee to park in a parking space in your lot, then you probably do not need to report that as unrelated business income. And I don't have the guidance in front of me to give you the code sections and what the regulations or et cetera are on that, but that did come up at a conference last week. And again, this was a higher ed conference, so there were colleges and universities, and so it was a situation where students, it's not that uncommon for a college and university to charge a student for a parking permit, but not an employee. If that were the case where they are charging some for parking, but not others, you would still have to report the cost to maintain that parking space for an employee as unrelated business income. But I think based on your question, you're indicating you don't charge for parking at all, you don't charge anyone for parking, and if that is the case, you have a good argument to not have to include the cost of the parking space for employees as unrelated business income.
Great, thank you. And how about we are a public utility and do not have a requirement to file a Form 990? Are we subject to the new provision that requires an excise tax on compensation over $1 million to any of our top 5 employees?
I can go ahead and take that one as well, unless you would like to chime in, Alex.
So my thought is yes, they would be subject to the new provisions that require an excise tax. However, I guess it really depends on what type. I mean, if they are a public utility, then I would say yes.
And this is Wendy. I completely agree with that. And one thing I'll add is that the IRS has not come out and said how you will submit the tax on the compensation. So, for example, one could think that maybe they're going to use the 990T and they're going to add a line to it when they revise it, and that would be the form to use. I'm kind of thinking they're probably not going to do that. They're probably going to use some other form that's already out there that's specific to excise taxes. So, for example, there's a 4720, which is used by a lot of our private foundations for various types of excise taxes. There's also a 720 that's used for the PCORI fee. I know I'm using an acronym, but that bit might be a form some of you have used if you have self-insured plans. That's specifically for excise taxes. So I would say that, yes, it doesn't matter that you don't file a 990. You're still going to be subject to it as everything is written right now as a public utility. It's just a matter of how you would actually report that and submit the tax. What form would be used? They have not indicated that yet.
Great, thank you. Our next question is the excise tax $1 million limit is on each covered employee, not the covered employees added together. Are we required to fill out and report the wages of the covered employees to the IRS?
So I was thinking this might be a good question to go into from our last one, but the 1 million threshold is applied to each covered employee, so not collectively. And then it sounds like Wendy kind of touched on filling out and reporting the wages of the covered employees to the IRS. They're still a little unclear on exactly how that reporting may occur or if there will be additional reporting. So I think that is something that is to be released hopefully soon. But Wendy, do you have any other thoughts on that?
No, I would agree with everything you just said.
Thank you.
All right, still have time for a few more questions. We received a reimbursement request from a new employee in January 2018 for moving expenses incurred in 2017. If we reimburse the employee for those moving expenses, do we have to include as taxable income?
I can go ahead and take that one. Unfortunately, yes, you would, even though the moving actually happened in 2017, because the reimbursement is not happening until 2018. That's basically under the new rules under tax reform, and that moving expense is now a taxable benefit.
And my apologies, I didn't chime in on that one because I was thinking we were looking at a different question, but I would absolutely agree. It's going to be when that reimbursement is paid, when it gets included in the employee's compensation.
Awesome, thank you. And let's go with, can you go over the fringe benefits for employee achievement awards again? What should be included in the W-2 reporting now?
I can talk about this one. So there's no changes to the law, like I said before. It's really just the definition of tangible personal property. So before, if you gave your employee an award, an achievement award, it was excludable from their wages, and the law says any tangible personal property that is given as an employee achievement award can be excluded up to a specific threshold. Before, the definition of tangible personal property was pretty loose. It didn't really exactly define exactly what that was, and so employees or companies could give an employee, a $100 gift card and say, okay, that's tangible personal property, and exclude it. Whereas now, it's still excludable, but they just now have really tightened the definition of tangible personal property, and specifically they've excluded certain items from the definition of tangible personal property. So now, specifically cash, gift cards, and meals and lodging are excluded from the definition of tangible personal property. So in 2018, if that same employer were to give an employee a $100 gift card for an employee achievement award, now that would have to be includable because it is very clear that a gift card is no longer tangible personal property for this purpose.
All right, thank you. And it looks like that was our last question. If you have any questions that you think of later, feel free to reach out directly to any of our presenters. I'll be leaving a console open for a few moments, so if you wanted to get a last question in, you can still submit that now. Otherwise, thank you, Wendy and Alex, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.